As we wrap up a week that's seen huge jitters around the imposition of 25% tariffs on automotives coming into the US, we end it with a focus on the core PCE price index. Now, inflation is going to be a potential sticking point when it comes to tariffs and the potential pathway forward for the likes of the US dollar and equity markets, because stagflation could tie the hands of the Federal Reserve. So it's going to be a big one. Let's go through the data and see exactly what the implications could be for some of these key markets. So first and foremost, as ever, we're going to be looking at the expectations within the markets. This is according to Trading Economics. So where do we stand? There's an expectation that we come in at 0.2% on a month-on-month core PCE price index. That would be a welcome decline following expectations over recent months that we're going to go higher and higher with those monthly CPI numbers in particular, but also with the PCE numbers. So that would be welcome news if we saw that figure. Remember, if we want to get back down to 2%, we need to start seeing monthly figures around 0.2 or below to get there. And that's not something that generally we've been seeing every single month. In terms of the wider picture, you can see the core PCE price index expected to remain at 2.6%. By and large, markets aren't going to be looking out for that PCE number, instead the core number, which is the favored metric at the Federal Reserve. And so as we look forward, the question mark here is, where's the direction of travel for US prices? The fact of the matter is that we're currently still in a position where we haven't seen the reciprocal tariffs being implemented. We haven't seen the automotive or the sector-specific tariffs being implemented. Of course, we've just heard about the autos. I'm recording this on Thursday. But there's probably going to be more. There's a potential for them to target the pharmaceutical sector in particular. And so all of that starts to build up a narrative about the potential for a resurgence in prices. Recently, what we've seen within markets is the growth in the idea that essentially the Federal Reserve are going to have to cut more. We're going to have to see greater easing because the economy is in a bit of a difficult position. The caveat to that is, of course, if we see inflation at the same time, then they have to choose between one or the other, right? So if we see inflation soaring, will the central bank cut rates? That remains to be seen. But certainly they are potentially going to take a more sort of active approach going forward, the Federal Reserve, because previously there was a feeling that they were happy to leave it all down to Trump, right? He might spark inflation, but he's going to be good for the economy. Well, now we're starting to see that he might not necessarily be good for the economy, albeit for the short term at least. And so if we see inflation, then you have that stagflation concern coming into play. Right now, markets are jittery, to say the least, because not necessarily because they think that, you know, this is going to be good news for Trump. They think that the announcements that are supposed to be good for the US, despite it being the US stock market, could lead the US down a pathway which leads to weaker growth over the near term. Remember, US equity markets are being essentially priced for perfection, and Trump's making an environment that is far from perfect. The uncertainty within markets means that businesses are likely to hold off on investments. Even if we see, say, automotive firms within the US actually benefit from the tariffs on cars coming in from abroad, most of those companies also rely on imports for parts to then create their cars, their vehicles. And so if they are to suddenly start to onshore much of this production, how long does it take to source land, build a factory, train people up, and then start producing it largely at a higher wage, because you're going to have to pay a much higher wage to a US worker compared to abroad? And so all of that feeds into a narrative where it's not necessarily good for domestic, it's not necessarily good for foreign either. And the potential for a trade war, it doesn't necessarily seem to benefit any of them over the near term. So price for perfection doesn't particularly work well right now when it comes to equity markets. That's why we're seeing, say, 2% declines for the Nasdaq on Wednesday after we heard that announcement. And then when we saw an open in Europe, you're talking about sort of 1% down, things like that, even though it's specifically targeting Europe. So US equities are particularly at risk. And there's a feeling that, okay, if the central bank now starts to cut rates loads, then that could be good for the US economy. But if we see the weakness in terms of the growth picture and we see inflation picking up, that's where it could be very troublesome. So all of that is to say this core PCE price index metric is going to be absolutely crucial. Like we said, it's 2.6 at the moment. And you can see here that we have actually moved lower recently. we've been tracking over the course of the last year or so this month-on-month metric and looking out for this period, February, March, April, to start seeing significant disinflation. And that's because, as we can see here, that you're looking out for those big sort of chunky prints on the left-hand side of that month-on-month section. Interestingly enough, this month, the CPI figure benefits from those base effects, but less so the core PCE figure, because you can see that yellow bar on the left-hand side for February is about half the size. It's closer to 0.2. So if we come in at 0.2 this time around, then it's just going to stay where it is at 2.6%. And then possibility for next month, maybe we see a little bit more disinflation to come. And it could potentially take us down towards the lower bounds of the sort of 2% realm. So, maybe get down to 2.4 or something like that. But soon enough, we see those tariffs kick in. And tariffs aren't necessarily a tax on the goods, the producers selling into the US. Tariffs are a tax on people paying for those goods. So US consumers paying more for goods, that's inflation, right? And unless they immediately start to reconfigure away from international goods, and in a highly internationalized and globalized world, that's not going to be an instantaneous thing, and people will pay more and inflation goes up. So at what point does that kick in? And when we've been waiting for this period at the beginning of 2025, as the period where we likely see disinflation really spark, that there's a question mark about where we're going to start seeing prices rise on that month-on-month basis. So markets are expecting 0.2 this time around, and so the question mark here is, if we start to see inflation pressures creeping in, do we come in higher? And if we see a higher inflation metric this time around, what does it mean for next month and the month after that, when we see these tariffs actually implemented and making a tangible difference? And that's where it could have a really significant impact on sentiment, particularly in the equity markets, and lead to the possibility of further downside to come. If we're looking in terms of the manufacturing sector, this has been at the forefront of the inflation story. We've seen the likes of the Philly Fed prices paid metric on the rise, the Empire State Manufacturing Survey prices paid on the rise, the ISM manufacturing prices paid on the rise. All of those sort of initial sort of indicators that you might a lot of the time look on the economic calendar and probably say you don't really care that much about it, right? They give you the leading indicator of what could be to come down the line. Now, goods inflation by and large hasn't been the problem. It's been services inflation over recent years. Goods inflation could become the problem. And so it's this counterbalancing of where services inflation is coming off, but goods inflation could be coming back up. And you can see that with these prices paid elements across all three of these surveys. Right now, we haven't seen a resurgence in terms of core CPI or PCE. But if that starts to change, then it changes the narrative within markets as well. In terms of market expectations, despite the fact that we have been hearing some news here and there about Trump and what he might or might not be doing, 1 minute we're saying, this is great. We're not going to hear any sector-specific measures being implemented on the 2nd of April. And then, on the 27th, so less than a week before that, he enacts the sector-specific move on autos. So, should be too happy. But the fact of the matter is, despite that choppiness, we've seen relative stability here in terms of expectations from the Federal Reserve. And that is for a coin toss, essentially, between 2 or 3 rate cuts this year as the sort of base case scenario right now. And so this inflation report, this inflation readout is going to be key in informing those views. So let's get into what it means for the markets. First and foremost, we'll look at the euro, and there we go. Let's get myself into small head mode. So this is the picture for euro dollar, right? Let's go on to the sort of wider time frame. So long-term trend is bearish, right? You can see that here very clearly. We've got this long-term downtrend playing out here. Not sure exactly where the trend line will be best from. Well, I should get out of the way. Oh, that's not right. Okay, let's just try and clip as many of these tops as possible. So that's the real top end. Let's just move that up there. That's the real top end. Then if you were looking at trying to get as close to some of these as possible, you've got this coming into maybe that as well. You've got a raft of these, quite frankly. I mean, it's quite difficult because they're all sort of picking up into different areas. But essentially, you've got this area where we've sort of consolidated in towards trendline resistance, then broken down. It points towards a possibility that this rally is a potential precursor to us rolling over once again. But certainly what we have been seeing is a shift, and that shift takes the shape of a US which is focused on cutting government spending. We're seeing question marks about the strength of the economy. We're seeing the possibility of rate cuts being factored in that hadn't previously been factored in. Then you've got the likes of the Eurozone. We're seeing higher spending. That means higher yields as people have question marks around the stability of the economy. And so we're seeing a shift in terms of sort of yields within these two regions. Now, if we're to look here in terms of, say, the US dollar against euro dollar, the US yields against European yields, let's just flip that around, invert that. So as we can see here, generally you have this relationship where the ratio between the 10-year yield in the US compared to the EU is a key driver of sentiment within the FX markets. Now, notably, we've been seeing in the sort of tariff announcement, we've been seeing the US 10-year on the rise, and that's what's driving this towards a downside, right? So essentially, you're seeing a pop here in terms of euro dollar, but we're not necessarily seeing that in terms of the 10-year. Let's see if over the near term we're seeing that. So yeah, so that 10-year relationship isn't seeing that pop. That points towards a possibility that this pop isn't necessarily going to last and that we start to roll over once again. And certainly if we were to see strong inflation coming into play once again for the US, I think would be likely to drive this lower once again. So we've come off the back of this strong rally. We're seeing a fade in terms of that ratio between the 10-year in the US compared to the Euro area. And that points towards a possibility of further downside. If we do see a weak inflation gauge, you could say, okay, great. We're right to be focusing on the potential easing of the central bank and not the idea that inflation might rear its head once again. But there's a caveat to that anyway, because anyone that sees a lower inflation gauge can just explain it away and say, well, tariffs are the things that we're worrying about in terms of inflation. They haven't, for the most part, been implemented, or certainly the repercussions of any of that been felt within the economy. So you can't say that if you see a relatively low inflation gauge this time around, then you think, all is well. Whereas if we see a strong inflation reading, higher than expected, then you can be like, okay, it hasn't even kicked in yet, but it's already higher than expected. So that means that any sort of upside move associated with that, I think, would be relatively tentative if we see a weak inflation gauge. But if we see a strong one, there's a good chance that we do see a move towards a downside for this and sort of give back some of the gains that we have been seeing recently for the likes of euro dollar. Then I wanted to talk about the Nasdaq. Now, Nasdaq's been hit hard recently, and you can see why. I mean, ultimately, it's a tech-focused index that, tech is the kind of area that is going to be hit hard. Tech has huge valuations. It's held by pretty much everyone because it sits in all of these pensions and everything. As soon as people sell out of their assets, tech's going to be part of that. And it's not given that someone within their portfolio holds, I don't know, a company in the mid to low part of the S&P 500. But it is a given that they pretty much are going to hold, Alphabet or Apple or Tesla or Nvidia. That's just the nature of the beast, right? And so when we see selling pressure, generally it's this index is likely going to be at the forefront of that, alongside probably the Russell 2000, because you see people essentially trying to exit their non-profitable businesses. But nonetheless, this is at the forefront in the sense of those sort of main three, because Russell's not traded as much. So let's look here. In terms of the wider sort of picture, you can see that in actual fact, what we've seen within this recent pullback is a decline from the top to the bottom of 14% decline thus far. But we've been climbing since then, right? So we've dropped into the 61.8 fib. We've started to rebound. Notably, that tariff announcement, so that sharp bearish engulfing, starting to rise a little bit here. I think there is a good chance that if the bears are going to come back into play, Friday could see that happen if we do see inflation coming in hot. Obviously, if it just ticks like 0.3 rather than 0.2, and, maybe that's not going to see a huge move. But certainly if we start to see those inflation pressures really building, and certainly when you look into the sort of nuts and bolts of that inflation report, if you start to see something particularly worrying, and people think, well, this is only the beginning of it. What would be the implications for monetary policy? What would be the implications for the economy that's potentially going to go into stagflation? It's the kind of thing that could really hurt stocks, and in particular the likes of the Nasdaq. So this is the recent sort of recovery phase. We can look at it in terms of sort of retracements. Initial one, very deep retracement, which is often the way because people think we're going to continue on that downtrend. The next move higher, we see a deep retracement into that sort of deep zones between the 61.8 and the 76.4. We've next come on the next move into the 61.8 perfectly, and now starting to regain some ground. Like I said, I could envisage a sort of near-term move into this area and possibly rolling over, but it comes down to the inflation report. If it comes in hot, then this is the kind of index that's likely to be hurt. There's going to be people that are bottom picking and trying to think, well, we've sold off on an index that has done incredibly well, therefore it's time to buy it. You know, maybe it is, maybe it isn't. But certainly there's enough fear and jitters within the markets and enough concern about what could be to come, given the fact that Donald Trump seems very steadfast in his approach to tariffs and saying that these are permanent auto tariffs. And of course, we've got April the 2nd to worry about, and the potential for pharma tariffs and the potential for a tit-for-tat war, and you name it. There's plenty down the line that should provide jitters. And inflation, for me, is one of the really big key concerns. If he sparks a fresh round of inflation, then you've got the possibility of potential downside here in terms of equity markets and the potential for an uplift in terms of the US dollar. So keep an eye out for these markets. Like I said, we have started to rebound from the 61.8 fib. You know, maybe that does continue towards the upside in a sort of calm manner if we do see that core PCE metric coming in at 0.2 as markets expect. But I am aware of the risks that come with a hot inflation reading for that core PCE price index metric on Friday. As we wrap up a month that's been an eventful one, and the next one's going to be just as eventful because, of course, like we said, April the 2nd is the day to watch for the possibility of a widespread trade war around the world. Great fun. My name's Josh Mahony, Chief Market Analyst at Scope Markets. I hope this has been useful. Make sure to like, subscribe, and follow for more content like this. Thanks a lot.